All right, what's going on, everybody? This is another episode of the 585 Boys podcast. You find us on YouTube. Today we got a good one. We're going to change it up a little bit. We're going to get into some financial situations here. We have Matt Newman. He is a wealth manager. Is that what you call yourself? Okay,
Yeah.
financial advisor. Where do you work, Matt? Let's get right into it.
So I work for a firm called High Probability Advisors. We're based out of Rochester, but I am our Western New York representative. So I actually live and I have an office in Buffalo. So
Okay.
primarily all Western New York, Rochester, Buffalo.
Really? Okay. Cool. So you work with not only individuals but small companies too?
Small and large companies.
Oh, okay.
We do a lot of retirement plans.
Okay.
We establish them and monitor and run retirement plans. And I work specifically with a lot of the participants and do a lot of participant education and with the business owners as well.
Okay.
There's a lot of incentives that both participants and business owners get from establishing retirement plans.
Yeah.
And we help, both parties kind of maximize the utility of those plans.
Okay. Cool. How this just interests me. How'd you get into this? Like when did you kind of know, I don't know if you're like middle school you were dreaming about this or like
Yeah, I think I don't know. I went to school for a generic business major, like most people probably don't have any idea, and I had very little exposure to anyone in this field growing up. I'm from a really small town in the southern tier, so
okay.
there's not a lot of financial advisors. It's a very underserved area of the world. So I didn't know what I want to do, and a couple of years into college, I got exposed to some people who are very successful at it, and made it obviously a very good career out of it, and we're making a lot of money. And obviously the stock market is a very interesting thing and dynamic and changes pretty frequently. So that's what kind of attracted me to it initially.
Nice. That's another thing I'm interested in, like, have you always been really good at math?
Not necessarily really good at math. It's it doesn't necessarily have to rely on crunching data numbers or being super quick with numbers. I think there's so many systems like every other career field that kind of do a lot of the math stuff for you. Kind of way quicker than you could. But a general understanding is obviously very helpful.
Right.
But it's none of the math that you would would learn in ninth or 10th grade.
Trigonometry,
it's
shit like that.
You're not doing very complex things like that. But with that said, we're getting more automated, and we're using math a lot more in everything that we do. Yeah. And it's a way to help cut costs.
Right.
And to improve, how any asset manager manages money. They're using math and using systems to invest your money for you. So I think that's where it could come into play. If you're really good in math, there's still a really good opportunity here for most people.
Yeah, I just feel like everybody hears, financial advisor, any of that. Oh man, he's got to be extremely. Yeah, exactly. Like he's got to be unbelievable at math, Right. But there's still calculators out there. What I'm saying? You guys are able to use.
I would say, what's more important than being good at math is being really good at Excel.
Okay.
And utilizing Excel and then all those programs that kind of stem off of Excel. And, I think you could apply it to any career field. Being good at Excel,
right.
You can kind of take that anywhere.
Yeah, that kind of pops up a lot. I'm kind of garbage at Excel, to be honest with you. Yeah. I'm good at Word.
I've gotten better.
I used to be good at PowerPoint because that's basically all we did in college, Word and PowerPoint. But Excel...
It's so good for organizing.
I know it is. I just am not great at it.
The depth of Excel is pretty shocking.
I'm sure
it's... you can actually do.
Yeah, I'm sure. So let me kind of get into some specific questions that I know I have personally. It's probably stuff I should know, but I just don't, Mm-hmm. So where I am, I'm pretty sure what I have is a 403B. Mm-hmm. I think that's what they call it. Is there a difference between like a 401k, 403B?
Yeah. and it's your employer, right? So your employer is the University of Rochester, which is a nonprofit, right?
Okay.
So that's the only distinction is nonprofits can use a 403B, which there's slight subtle differences that don't really matter in this aspect.
Okay.
When a 401k is for a profit organization.
Okay.
Some nonprofits do have 401ks.
All right.
It's just a matter of how they set it up and why at the time that they set it up, which isn't really relevant
Okay.
for now.
All right.
But yeah, so that's the only difference. Typically, 401ks are more of a benefit because you'll see a lot of nonprofits have additional retirement plan options like a pension potentially you may have access to.
Yeah. I think they used to, but
They used to probably recently. They've gotten rid of it for your age range, but
right.
So but your 403B is probably a really great benefit that you and your peers can take advantage of.
Yeah, and I try to. I think they give you like a couple years, then they start matching. Yeah. You have to go into it at first. Yeah,
right, yeah.
So, kind of on that same subject, is that? I mean, I know it kind of differs with the person, but is that all people should be doing? Is just kind of just stick with your benefits, stick with what your job is going to give you, or is there other options out there?
Well, there's definitely other options, but I would say your most useful tool that you likely have is if you're employed by a larger company or even a small company. Most companies these days have retirement plans in place as an employee benefit. Well, you want to make sure you're maximizing that benefit. Because you could potentially be leaving money on the table. Because most people or most employers have an employer match potentially.
Yeah.
And I'm sure you've heard of it. Most 401ks typically match 3% of your income as long as you're putting in 3%.
Right.
So they'll match dollar for dollar 3% of your income as long as you're putting in 3% as well. If you put in 4%, well, they're still only going to matching 3%. But some people maybe can only afford at the time 1% or 2% or $100 or $150, whatever their structure might be, and they're leaving money on the table from their employer. And from our perspective, you're getting 100% match your first 3%. That's 100% return guaranteed right away.
Right.
And that's something that any investment advisor will not and cannot guarantee for you right away. So your first step is to see what your benefit is, see what the employer match is, and take full advantage of their match.
Right.
And then go above and beyond that and challenge yourself to increase that year over year.
Okay. Yeah.
So maybe start at 3% if you're paycheck to paycheck.
Right.
Because you got to remember, most contributions into a retirement plan are going in pre-tax. Okay.
Yeah.
And I wish I could show an example like on a whiteboard or something like that. But let's say you make $100 in a week. Okay.
Yeah.
You put in $3. Okay, that's going in before taxes.
Yep.
Okay, let's say you're in a 25% tax bracket. All right. Sorry, I know I said I'm not good at math, but hopefully you guys can all
No,
follow
we
me.
get it. We get it.
Yeah. So, if you don't contribute to the plan, you're in the 25% tax bracket. That $100 is $75.
Okay.
Right.
Yeah.
Okay. So your take-home pay is $75. Let's assume nothing else. Okay. If you do participate in the plan, you take that $100, you put $3 into the plan, so that's $97, and then the $97 is taxed.
Okay.
Okay. So you may only be missing out on $2.50 that goes into your actual paycheck that you take home, but you're getting $3 in the plan plus your employer's match, so that's $6. To get $6, you're only giving up $2.50 of take-home pay. So that's an example that we use a lot with our participants in our plans that we work with to try and really increase participation. I think there's a huge issue with retirement readiness. And as you alluded to, we've shifted away from pension plans that really help people prepare for retirement. And now the onus is on the average employee to take care of themselves. And Social Security is meant to only supplement your retirement.
Right. Yeah.
Right? It's only meant to be a quarter to a third of your retirement income.
Right.
The rest is on you to prepare for. So a retirement plan is that vehicle that you have instead of a pension that our parents probably have to prepare for retirement. So, that's why you're seeing so many of these baby boomers work, into their 70s because they're not prepared for retirement because their pension went away, whatever. And we're just transitioning into the 401k. So really, we need to do a better job as a society is educating everyone to save more money in their retirement, to prepare for a timely retirement, and be able to fund their goals and their spending needs during that time so they can enjoy themselves, right?
Yeah, yeah. And I feel like that should be something that we're taught high school.
Yeah.
In a class, just as an introduction.
Sure. But how many, average high school teachers that have a pension, that never had a 401k, never been exposed to having to save for themselves, how many of them have this knowledge, right? So there's kind of this gap where this teacher probably was in a school their whole life, and they went straight to college, and then they went back to high school to teach. So they'd never been exposed to the real world to get that experience and then to be able to relay that to a student. I understand why they're not talking about it because they probably don't know. And not to mention, most schools have 403B plans that don't that don't match in addition to their pension. So rarely do teachers actually participate in those 403B plans because they have the pension available for them. So
all right. Well, that makes sense then.
Yeah.
Why they don't teach about it.
But they should, absolutely.
Right. That's a course they should start.
Yeah. I don't know. I just feel like there's a lot of things that, this is a totally different subject, but a lot of things that aren't being taught that should be. And that's one of them.
Yeah, things got to start shifting, kind of.
Right. So this is just a question I have just for me. What is a hedge fund? And what is like hedge funding?
Yeah.
That's just purely my imagination working here.
Yeah.
That's all.
Well, there's different levels of asset managers, right? So I'm a financial advisor. I work with more everyday people, and I work with some high net worth individuals. We may take some of our high net worth individuals and recommend that they use a particular hedge fund to help diversify their portfolio. Okay. The best example, or the most simple example of a hedge fund, is a speculative investment. Okay, hedge funds have the ability to do anything. They can buy private companies. They can buy public companies through the stock market. They could buy bonds. They can buy. They can sell stocks like they did with GameStop. I know we were talking about it earlier. So they can actually buy and sell positions. Okay, without them owning it, meaning they can short positions. So we call it long. They could go long, meaning they're buying it, or they can go short, meaning they're selling a stock. So they make money as the stock goes down. Okay. So basically, when someone says hedge fund, it's just that's just a general term for all these different types of investors. And different hedge funds have different niches that they operate in, right? You could have a long short fund, you could have a short fund, you could have a bond featured fund, you could have a private equity fund, which is completely different. They're just buying private companies. So, hedge funds kind of gets all lumped together, but hedge literally means hedging your current positions. So the reason why you might use a hedge fund or hedging your position is if you own, let's say you own, trying to think of a stock around Rochester. I was going to say Kodak. That's a really bad example. Let's just say you own Amazon and you bought it 10 years ago, right? And it's in a taxable account. So meaning if you sell that position, you're going to owe capital gains taxes, which is a huge detriment to that position. So instead of selling Amazon, they may take temporary short positions in Amazon to protect their huge exposure that they have to Amazon. So you might implement some hedging strategies or use a hedge fund that goes long and short different securities to help diversify the portfolio without realizing a tax event.
Right.
So that's really where they came into play. Now, super wealth. So you have to be wealthy or you have to be an accredited investor to be involved in a hedge fund because your decision making is at another level.
All right.
And you have to be able to afford some of these decisions. So when you hear negative news about a hedge fund, it's likely because they've lost a lot of money and it was other people's money, because a lot of pension funds, bricklayers or something like that, masons, whatever pension that people have been putting their hard-earned money into years over years, and they diversify those assets with asset managers like us. They use hedge funds. They use big companies like BlackRock and Vanguard and all those names that you've heard of before. But a small sliver might be in a hedge fund, and it may have lost millions of dollars or have gone, because it's very speculative. So it's very volatile. It could be boom or bust kind of situation. Okay. And that's fine if you only have a small sliver of your portfolio in that. But sometimes they had too much exposure, and then there's a lot of fraud because there's very loose rules. They're not monitored by the SEC like the rest of us are. So that's probably why they get a lot of bad news. Okay. And again, that's sensational. It's always the rich are bad, and the poor, like to buy that magazine issue or watch that TV. Or so it kind of gets that sort of vibe. But, so that's probably why you've heard of it a lot, but may not fully understand what it is. Exactly. It's a very general term. It's a very broad subject, I think.
Okay. Cool.
So I want to kind of just step back because we talked about, like, you have, Johnny, you have, your 403, whatever, 401s, for the companies that offer that. But what are some options for people that are self-employed, that don't have, what should they kind of look to do?
Yeah, so at High Probability Advisors, we fundamentally believe in low cost, okay? Because that's one of the biggest drivers of investment performance, is keeping fees and costs very low. So you're going to want to find a strategy that is one low cost no matter what you're doing. Right. And you're going to want to kind of stick to that plan through time. Right. And not trying to get in and out of timing the investment market. Now, the vehicles that you can use as a self-employed individual, or even if you own a small company, there's a lot of tools available for you to be tax efficient and to prepare appropriately for retirement. So in your situation, you could start what I'm recommending mostly to my clients in your situation is a solo or an individual 401k. So there's very little administrative hoops you have to jump through to establish this. Sure. You get all the benefits of a big 401k plan, except you're acting as the employer and the employee. So you get to double your contributions to the plan. So if you're doing really well in any given year, it essentially doubles the amount that you can put into a retirement plan. Oh, okay. So right now, Johnny's capped at putting in $19,000 a year. Right. You as an employer, you can do both sides. Okay, you can do $19,000 plus whatever match contribution we come up with, maybe 3%. In addition to that, you can do an excess employer contribution to that. Oh, wow. So it's a very powerful tool for self-employed individuals who, have the means to really prepare for retirement. Sure. But if you're just, a more average kind of situation, just starting off, starting in your career, and you need that money to reinvest in your business, yep. You don't necessarily need to run it through an employer-sponsored retirement plan. You can get what's called an IRA or a Roth IRA outside of an employer, and that's just in your individual name. Right, right. So for young people like us, I encourage a lot of young people to make Roth IRA contributions. Sure. And the theory is that what a Roth IRA contribution is, you can make it, but you don't get the tax advantages today. Okay? You get a tax advantage when you take the money out in retirement. Okay. So the concept is you're young in your career now. You're expected to earn more later in your life, hopefully around retirement time. Your career has grown and plateaued. And at that time, you're likely spending more than what you are now. So it's a simple math equation, right? Right. The taxes now are X. The taxes later are going to be X plus, they're going to be a higher number.
Sure.
Right? So you're going to take advantage of a lower tax rate, pay it now. That grows completely tax deferred. When you take it out in retirement, you can take it out completely tax free.
Oh, okay.
So that it's grows tax deferred and it's completely tax free if you take it out at age 59 and a half.
Wow. Okay. Cool.
Nice.
Yeah, that's awesome.
Yeah, so that's called a Roth IRA. The other side of that is a traditional IRA where you take the tax advantage now. Okay, so you can put in $5,500, I think, this year, and that reduces your income by $5,500.
Oh,
so whatever
okay.
your tax rate times $5,500, that's the real savings that you've made.
Right.
Okay, so that's how they're incentivizing people to prepare for retirement. They're giving you a tax break.
Oh, okay.
So we really like the utility of the Roth IRA, or at least I do personally, because it's a tool you can use for education savings. You can use it for emergency planning potentially if you've had it open for long enough time. Emergency meaning like medical expenses or something like that. And
That's nice.
Yeah.
And again, education and emergency funds, and you can take it out as long as it's been open for 5 years, and you only owe taxes on the gain inside of the portfolio. So if you absolutely had to take it out, we strongly discourage it, but it's
Right.
not as big of a hit as what a traditional IRA would be.
Okay.
Sure. Right.
Okay.
Cool.
What are some of the not like cons? Like, is there anything that can have like with my retirement account?
Yeah.
Is there any way that it could just not be there? You know what I'm saying? Like,
Yeah.
when I try to go to retire, if I'm just, I think I'm in a just like the safe,
Sure.
kind of, because I know there's more, like you said, like more volatile where you can really go at it,
Yeah.
But mine's more of like the safe, whatever.
Right.
I'm not sure what they call it, but
Right. So I think the biggest, I guess, hurdles or kind of landmines that I guess could happen is being inappropriately invested for your given situation, right? And that's kind of a bigger issue than it not being there, because 403Bs are individual accounts in your name. That money isn't pooled with your employer's money like a pension would be.
Right.
Right? So it's your account, it's your decisions on the investments. Any of those types of plans should be very hard to make major mistakes.
Okay.
And that's intentional, right?
Yeah.
So we design our plans to be very simple and to be very hard for the average employee to make a huge mistake with their investments.
okay.
So, the mistakes that we see that are able to be made in 401ks is people are all cash and they're not aggressive enough. If you look back what has happened the last 10 years, if you're all cash, you're actually losing money in your retirement account because inflation, the gallon of milk that you're buying 10 years ago is a little bit more expensive today than what it was back then. So you're actually losing purchasing power if you're just too conservative.
Okay.
And there's no really aggressive approaches in a retirement plan unless you're nearing retirement and you're just being a little bit too aggressive
Right.
with your funds, which they make it difficult for that to happen. And most do have, like you said, conservative, moderate, and aggressive types of funds that you can use that automatically diversify you, where you don't even need to make investment decisions necessarily. You just need to dictate what kind of person you are.
Okay.
If you're too aggressive and you see the stock market go up and down and you react to the market when it's down, and you go from the aggressive fund to a conservative fund, and then the market recovers, well, you just missed out on all the gains that the aggressive fund would have had. So you want to pick the right asset allocation for your personality and your comfort level in all market environments, for the ups and for the downs.
Okay.
Generally, if you have a long investment time horizon, you want to be as growth oriented as you can.
More aggressive in the beginning, right? And less towards the end.
Yeah. The term aggressive is relative because
Right.
When we say aggressive in the retirement plan realm, it's not necessarily aggressive like speculative, like a hedge fund would be,
Okay.
or any other individual investments. These are all very diversified generally and appropriately set up for someone of likely your age.
Okay.
And if you have the availability of target date funds that you can pick the date that's closest to your retirement, it automatically gets more conservative as that date approaches, which a lot of employers are utilizing those these days, and that's what we would recommend as well.
Okay. What is the age right now? Is there like a set age you could retire without penalty, or does that change?
Well, you can retire whenever you want, right?
Right. Yeah. Yeah.
If you have the means to do it, but age 59 and a half is the age where you can withdraw money from your IRAs without a 10% penalty.
Okay.
Okay. But it that's overly generalized. Like you can retire whenever you want. We have people who work to 80 and people who retire early because it all depends on what kind of retirement lifestyle they want to have.
Okay.
Yeah. It depends on your spending. That all dictates what, how much money you need in retirement.
So that kind of goes along with the next question I was going to ask, because you always hear different things like what you should have saved if you're going to retire. Is there, like, do you guys talk about, or do you have personally a set number that you think people should have? I know it's going to obviously depend on the person.
Yeah. Unfortunately,
so it's
it depends on how much you spend, right?
Right, yeah.
It depends on your lifestyle, and depends on what lifestyle and goals you have in retirement.
Right.
Generally, you can look at your portfolio and say, a 5% withdrawal rate is something that can make that portfolio sustain for a very long time. But it depends on what market environment you're in.
Okay.
Right? People who retired in 2007, and then we had 2008, that market crash, they had a different experience than someone who retired, 20 years before that or 20 years after that at this point. So, all those different factors really play in.
Yeah.
So there is no number necessarily, but what I see is there's people who spend, and then there's people who save.
Yeah.
And generally they don't change or flip-flop roles even in retirement.
Right.
So the spenders will spend, and the savers will save. So we can try and help both parties prepare for whatever they are. So some people need more in retirement, and some don't need as much because they live very lean, and that's just the way they are.
Yeah.
So, I think more importantly is let's get an understanding of where you're at and how you improve it. Right.
Yeah.
We have a dynamic software that kind of projects retirement scenarios, and we'll punch it in for you and see where you land, and we'll just make improvements, and it's fluid, right? It's never set in stone or something that you follow or you have to abide by. So
now this kind of goes back to a little bit earlier, but can anybody come to you guys depending on what their situation is? Can they just as an individual, I'm saying, like, and use you guys, to help out with all,
Yeah, so we, anyone obviously can come and work with us.
Right.
However, we're a business.
Yeah.
and we, we're a low-cost provider, but we have full services.
Okay.
So we're not cutting corners just to, cut our services. We provide a full range of services, but generally we need our accounts to be at least $500,000 or more to get the exposures that we want for our investment philosophy.
Right.
But we work with retirement plans, and a lot of the participants don't have that amount. So in aggregate, yes, we work with a lot of people who don't have $500,000.
Right.
But if we're coming on an individual, we generally it's $500,000 or more.
Right.
For us to do our full services, like do a financial plan and to get the allocations that we need in our retirement.
Okay.
But we have a lot of clients, kids,
Yep.
and things like that have much smaller portfolios.
Right.
But generally that's the size.
Okay. I just keep getting questions popping into my head.
There you go.
So, say, and this again could just be dependent on your plan or whatever, but say you're changing jobs. The next job you're going to doesn't have the same plan. How can you transfer that over without a penalty?
Yeah. So you can take any qualified plan is a 403b, a 401k, an IRA. Those can all be consolidated at any spot, right?
Okay.
So if you go from the U of R
Yeah.
that has a 403b, you can transfer it into an IRA, and it maintains its tax status. There's no penalties. There might be some small distribution charge,
Right.
like, charged by that record keeper, whoever's managing the money at the time. But as long as it maintains its qualified status and you don't put it in an individual bank account, which is a big mistake,
Right.
you should maintain its tax status, and you should be able to transfer it between all three. So you can take an IRA and go into a 401k, and vice versa.
Okay. Cool. That was always something
Yeah, and most people, I'll explain it a little bit further. The 401k is generally less expensive, but you don't have anyone managing it. You're managing it yourself, right? It's participant directed. And you're benefiting from the scale of all the other employees' assets pooled together, and you're getting a much cheaper cost break rather than having like us manage it directly.
Yeah.
So there's that advantage, but the advantage of moving it out of the plan is that we're actively managing it for you and all of our other planning services as well. So there's reasons to keep it in retirement plan, and there's reasons to get it out.
Okay.
But they do limit you on what you can take out of your retirement plan if you're still employed.
Okay.
Each plan has their own rules when it comes to that.
Yeah. So this one's a little bit onto a different topic here. What would you suggest, or maybe you even do it, for little ones? I know you got a couple of little ones.
Yeah.
What would you do? Are there plans? Are there certain accounts you can put money in for them and just where they'll grow? Or what's the best kind of accounts for them? Or is there?
Yeah, so, I have a pretty strong opinion on this, and I think this is where we can kind of show our value as advisors. And it's unfortunate that we can't work with more people.
Right.
But, we're literally limited to the number of people we can work with. But and the general public doesn't really understand this. Normally, you would assume that a 529 is the best option. What a 529 is, it's a college education savings plan that you put money in. You get a small tax incentive on the way in, and it grows tax deferred. And if you use it for education, that's great. And there's no penalty if you take it out and you use it directly for college education expenses for your kids. But the issue with 529s is it counts against your children on the FAFSA forms.
Oh, okay.
So when you're applying for a school and you're looking to get financial aid, you could potentially, it could be a detriment, the assets that you have in a 529 that's in your kids' names.
Right.
And by the way, you can't, say you have 3 kids, you can't just load up your youngest kid's 529 as your oldest kids go to school. No, they aggregate it all together, all 3 529s, to see what the oldest kid has. It doesn't matter if the youngest actually has the money or just a small amount. They're going to aggregate it as if it was all the oldest kids, so people don't just swap it back and forth.
Yeah.
So, and that's at a rate of 6%. So if you have $100,000, they're expecting you per year to put in $6,000 of your, you're going to get $6,000 less of financial aid because it's expected you're going to use that money for it. So people don't necessarily understand that, and why would you? Because how many times has your kids gone to school?
Right.
That's
definitely something I wouldn't even think about.
No.
No.
Right. So, what we what I encourage my clients who are in that situation is to fund college expenses through a Roth, because the rules right now is you can take Roth contribution, you can take Roth money out to pay for family education expenses.
Okay.
And it's twofold. So you have a retirement account in a Roth that's generally made for retirement accounts, where you can use it for retirement in case your kids don't go to school, or in case they get a full scholarship or something like that. So it's kind of a backup where the 529 doesn't allow you that flexibility. Or you can use that to use the Roth assets for education expenses, and it doesn't count against the FAFSA or the financial aid requirements. So,
that's
but there is, there's obviously a different side of the story.
Right.
Right.
Yeah.
So most people who are it's very easy to become ineligible for financial aid if you're making too much money.
Yeah.
So then, 529 would have made sense.
Right.
So you have to look at every person's specific situation before you make that recommendation. Okay. Because if you're incomed out of financial aid eligibility, well, then you should have had a 529 because it doesn't necessarily matter whether you're using the Roth or not. You should have done both, right, or something like that to take advantage of the tax advantages on the way in, et cetera. So, really, it's way more complex than just generalizing, saying no, you should have done this versus this.
Right. Situational again.
Right.
A lot of it's situational.
Right.
Okay.
Yeah.
I gotcha. So, I'm sorry. You can go ahead.
No, go ahead.
So, what happens if you do save in the educational fund and you have a kid that gets a full ride? Where's that money go?
Well, you can pass it on to your family members.
Okay.
Right? So if it's the oldest son, you can shift it to your younger son.
Okay.
Yeah, and then they can give it to their kids.
Oh,
and it continues to grow tax deferred.
Okay,
So,
but it's
yeah,
for education.
for education, right?
Okay.
Yeah.
All right. Cool.
Wow.
I never even,
Yeah.
That's
Yeah,
a lot of different things to think about here.
I think what's more important is, do you have something?
Right.
Is there something in place? Is there a plan in place? How are you going to fund it? Before you get into the nuances of which method to use, right?
Okay.
So, I don't want to discourage people from using 529s by any
Right.
means, but, you should consider it, and that's where we can add value, where that pays for a fee 10 times if we get in there and make those types of recommendations,
Right.
and you're taking advantage of that.
Okay.
Yeah,
Cool.
because, not to really digress, but if you have two kids going to school at the same time, and you were income out of it, but now you have two going in, well, now you are eligible for potentially some financial aid. So there's really, every situation is different. And it's so complex, and you can really get into the weeds of it.
Yeah, I can see that for sure. Okay, cool. And we got some. I got just some random questions here. What in the hell is cryptocurrency? Like, I don't even know what it is, but we're invested a little bit in Dogecoin.
Okay.
I don't know what it is, but it's grown a little bit over the past little while.
Yeah.
But I mean, Bitcoin's ridiculous.
Right.
Is it an actual currency that we can use?
Well, I think that's what's to be debated.
Right.
Is how usable is it, and can you use it for everyday items? And I think that's the biggest issue with it right now.
Okay.
And that's what some of the larger banks are looking at, is like, can we, because they're very invested in this whole conversation, obviously.
Right.
Because they're based in USD, essentially. And this could be hugely detrimental to them because they're transactional based. And as you know, well, maybe you don't know, crypto, it makes its own transactions. Okay. So it has its code, or whatever the code is, and in order to give it to someone else, it's just realignment of that code. This might be a really horrible example, and I don't understand it necessarily.
So it's not an actual coin. Like, it's not actual currency that you're holding.
Right.
Okay.
So it's a computer code that when you make a transaction, it becomes a slightly different computer code, and now it's in your account versus someone else's account, right?
All right, yeah.
So the problem with it is the time it takes to make a transaction.
Okay.
Where a bank, you can do it almost instantaneously with a wire transfer.
Right.
It takes massive computer powering to make a transaction, which is why you might see people having crypto farms, in their attic or something like that. Well, really, they're processing transactions.
Okay.
So the issue today is that it takes so long and so much computing power to transfer anything.
Right.
So that's why banks just can't do it right now because it's just too much to make a transaction. It needs to be more instantaneous, and that's really what we're demanding. And that's why you haven't seen it come into you're not using Bitcoin to buy milk at Wegmans.
Okay.
So I hope that answers kind of what you are. And
no, yeah,
in each currency, I guess, has its own niche, and they're kind of just copycats of the original. But hopefully, they're trying to improve its utility. And maybe Dogecoin is a little bit quicker than what Bitcoin is originally.
I hope so.
With every currency, if you really scale back and think about what a currency is, there's no gold backing our dollar anymore.
Yeah. So
it's all our interpretation of what the value of a dollar actually is, right?
Yeah.
And it's economists have studied it for forever, and they still don't get it right. It's just the value that we place on the dollar and the value that we place in Bitcoin. So, it's just as volatile as trading any other security.
Okay.
It just is, it's sensationalized a lot by, our generation, I think, for sure.
Yeah, for sure.
And younger generations. But it could be a really interesting thing to get into in the future. And I've known just recently, I've heard that mainstream investment companies are starting to invest in Bitcoin. So the more it gets, accepted by institutions like that, the bigger it could come into a daily role in our lives.
Okay. Yeah, because I can't remember which player it was, an NFL football player, just had his contract extended, and he had him put like 50% of that contract into Bitcoin, and he made out a ton.
Yeah,
and Jesus. I'm like, what is going on right now?
That's crazy.
It's insane. Yeah.
But I'll say this, I think it's the 80-20 rule, where 20% of people, it works out really well for them, and you hear about it, and 80% of the people, it doesn't work out well, and you can apply that. Across the board investments. Say any investment. Even GameStop, probably the same situation happened, where it's a higher likelihood that you mistime it, than that you get it right.
Yeah.
From our perspective, what we care about is that whatever you did, whether you made money or lost money, is that repeatable, right? Can we prudently implement a strategy to repeat that going forward?
Right.
Probably not.
Right.
Okay. And I kind of asked, Jordan kind of gave me a little bit of a explanation about what is insider trading? Like what?
Sure.
Like the actual, not word for word definition, but what is considered insider trading? What?
Yes. So there's a lot of public companies that we know about, right?
Yeah.
That are traded on the stock market, all day long. What insider trading is, where someone has access to information before the general market does.
Okay.
So it's very important for a public company to set, a press release or something that's at this time, and this is going to happen, and you'll know it at that time.
Okay.
But if that information gets out, a week in advance, a couple days in advance, and people trade on that, that's insider trading.
Okay.
Martha Stewart is a good example of someone who somehow she found out that a company that she was invested in or had ownership in was going to fail or miss their earnings projections. And if you miss earning projections, the stock generally goes down.
Yeah.
And she acted on it, and she got caught.
Okay.
So, it's pretty obvious when you're making large bets before or after some sort of news release that you question why did you do that at that time, and then you follow the breadcrumbs, and then you find out that it was insider trading.
Okay.
So it's kind of it's a very subjective
thing,
but you're not allowed to, if you know information that the general public doesn't know, you're not allowed to transact on it.
Okay. Okay.
And that's just something we don't have access to, so we're not really
right. Yeah. Yeah.
We're not, at risk of that happening to us.
Yeah.
If I was at risk at that, I would probably make a lot more money.
Yeah. Yeah.
And I think you could argue that some hedge funds might have a leg up.
Yeah.
And get news a little bit quicker. And I think high frequency trading, which is another thing, that's what they try and do. They try and get information a little bit quicker than the next guy, and they buy and sell within that time period.
Yeah.
And that's something that's happening around us.
Yeah.
These days as well.
Okay. Cool. That's cool.
Yeah, man.
A lot of stuff here. A lot of stuff. Here's kind of another stupid question for me. And I have a lot of questions about this. I never even realized. Lottery. Mm-hmm. What if I hit the lottery? Lot of money. Mm-hmm. What do I do? What's my next step? In terms of, and after, obviously I always hear you got to get a lawyer.
Right.
Pretty quick. But in terms of financial management with that much money.
Yeah, so obviously you're going to want some advice on what payout, because I've heard they give you different options.
Yeah, yep.
So you can annuitize it or take it in payments over your lifetime, or you can just take a lump sum, which I think generally a lump sum is better, especially now because it's all predicated on interest rates, and interest rates are really low, as you know, as a realtor, that it's easy to get money.
Right.
So those payouts are all based on interest rates. So you take the lump sum, and then you want to find someone that you trust that's not going to sell you something and put you in a position where they're making decisions that aren't in your best interest.
Okay.
So, number one, going back to, high probability advisors and, the fact that I'm a CFP, we have to act in the best interest of our clients. And there's a lot of people in our industry that's not necessarily true, and they don't abide by the same standard that we have to act in. So anytime someone's trying to sell you an investment or insurance product that has a commission attached to it, they don't necessarily need to act in your best interest. They may say they are, but if they're earning commission, then they're not acting in your best interest, or they're not held by the same standard that we are.
Okay. Well, that right there is good to know in itself. Right. Yeah.
So I think I would find someone you're comfortable with, and that's going to give you good advice. And I definitely wouldn't go get help from your cousin or or anyone who's in the field who you may know, or your neighbor or something like that. I would and I would shop around for sure.
Okay. All right. Yeah. So that's probably why it takes people a little bit longer to actually turn their ticket in, because they're probably looking around.
They're probably assembling a team, right?
Yeah. Okay.
And it's probably at their lawyer's advice. And, maybe their lawyer's telling you who to invest with.
Right.
And they're probably getting a back channel cut as well.
Okay.
Kickback.
Yeah. So
I'm sure.
I'm sure. I think you got to monitor from all aspects.
Okay. Cool.
Yeah. And then, you want to, I don't know, I guess we could get into that really deep, but you want to get some good advice and not be too crazy with the first few years of spending money, right? Yeah. But it's very hard to do if you don't have it, and then all of a sudden you do.
You have a lot of it. Yeah.
All changes.
Yeah. Jordan, you got anything else financial-wise?
No, I just want to know if you're holding on to a lucky lottery ticket.
No.
Yeah.
Not right now. No. Not on air. No. So I've seen a few times more about Hobbies and stuff like that. You do boat racing, yacht racing, stuff like that?
Yeah, I mean, it sounds super pretentious, but I do have a boat that I race.
Yeah.
And it's a big hobby of mine, and just getting out in the water really
sounds awesome. Yeah.
Yeah, it's an awesome lifestyle, and it's really not as ritzy or whatever as you would expect.
Right.
I grew up, fortunately, we inherited a very small 800 square foot cottage really close to the yacht club, and instead of sending us to a daycare program. They just sent us to a sailing camp that my older cousin ran.
Oh, okay.
So it was a good way to get us out.
Yeah.
The funny part is my brother, made a career out of it. He works full time in the sailing industry, which is really interesting, and I just do it as a hobby.
Yeah. Yeah.
But at the same time, I grew up at a really small town outside of the lake, and I played basketball. So there's not many people who played college basketball and also have a sailing background.
Yeah.
So I'm very diversified.
Yes.
In my background.
Yeah.
It's not all just I grew up at a yacht club.
Yeah. So your brother works in the industry?
Yeah.
Who's winning in a race?
I think I am. He's not.
He's not more.
Yeah.
Not for the speed, anyways.
Yeah.
He
depends on how fast the wind's blowing.
Yeah, exactly. It's obviously way more complex than that. But
yeah.
I think I probably race more than he does.
Okay.
Because he's the person who's organizing like a junior sailing camp and organizing the races. So I probably do more high level racing than what he does, and I'm sure he would have a different answer.
Yeah. Oh yeah, I'm sure.
Yeah.
Yeah. I just wanted to see if you would say that you'd be the one winning that one.
Yeah.
Do you ever go down to Alex Bay for those poker runs and stuff, or it's just strict competition racing stuff?
Yeah. So I do travel all over the country really to race the boat that I have. And it's a very low level hobby style of racing. It's not, we're not big money,
right?
Putting a bunch of a race team together or anything like that. It's more for fun. Equally as much as I love being on the water, I love the environment and the party that goes on.
Yeah, absolutely.
So that's it's both social and getting that competitive.
That's
edge
awesome.
out there, right?
Yeah, it looks cool as hell to me. I don't know. I'm just interested in that. Yeah, I don't know too many people who do that, so that's cool. That's cool. Well, look, man, I know you're a busy guy. Work. I know you got the two little ones at home, so I know you got to get out of here. We appreciate the hell out of this.
Yeah, definitely.
We know you didn't have to do this, just to get it scheduled and all that. It's cool as hell. Thank you. We really appreciate it.
Yeah, no. And if you have any more questions, I think for you guys or anyone who could be listening, our website is highprobabilityadvisors.com.
Okay.
And you can feel free to look me up. It's Matt Newman, and my contact information is on there.
Perfect.
Send me an email or give me a call. I'm sure you guys would relay the.
Yeah, absolutely.
We'll add all that information in the down below in the comments and stuff.
Great.
Absolutely, man.
Yeah.
All right. Yeah. Thank you very much.
Thanks a lot.
Appreciate it. All right, guys. We'll see you later.
Peace.